Hello everybody, this is Toni Turner and welcome to the market now as of about noon Eastern on Friday, October the 5th. Well, U.S. stocks are falling so far today as Treasury yields move to 7-year highs after the September jobs report did little to alter the view that the Federal Reserve would continue to gradually raise interest rates. U.S. job growth slowed sharply in September, missing economists' forecasts. However, jobs numbers for July and August were revised higher. The unemployment rate fell to a nearly 49-year low, suggesting the labor market has tightened further while wages rose steadily, pointing to moderate inflation pressures. And on that note, let's look at 3 charts that could give us some insight into the week to come. As we always do, we're going to look at a daily chart of the S&P 500 spider, symbol SPY. As you all know, this tracks our very important benchmark index, the S&P 500 index. Now, we know that the SPY made an all-time closing high back here on October the 20th of September 20th at $293.58. That's about $29.35 on the S&P 500 itself. Now today, when I captured this chart, the SPY was trading at $287.23, or again about $28.72 on the S&P 500 itself. Now, as you can see, yesterday, Thursday, the SPY fell below the red line, the 20-day moving average, which was coming in at about $290 and change, stayed below it again today, and is currently trading just below the important 50-day moving average, which is coming in at $287 right and change, right above where the SPY is trading right now. So the RSI, if we look down at the 14-day RSI, we note that it has pulled back and down away from overbought territory. In fact, now the RSI is at 41 and heading for oversold territory. Now, if it gets down to this line here, the RSI will be down to the 30 line on its scale, and if it moves below that, it means that the SPY would be in oversold territory, which would mean that it probably would bounce a little bit soon. We also see the trend line here, the uptrend line. Fortunately, the SPY is still in an uptrend, although we do see it here losing a little of its mojo. We see the uptrend line that I've drawn. It's touching 3 places for sure, so that means that it's a major trend line, not too long of a term one, but certainly a major trend line, now coming in at just above 285. So that could provide potential support to the SPY should it need to move back down to that area. Of course, 285 on the SPY would equal about 2850 on the S&P 500 itself. So we're going to be watching the 50-day moving average and this trend line coming in again just a little over 285 for potential support here. The MACD isn't doing much. It still is moving slightly, ever so slightly lower down toward the 0 line right here. So all in all today, what we see is as interest rates are rising, as I just said a minute ago, the market is starting to say, okay, I've had enough of that. I'm going to start to fall right now. Now, if the SPY comes down and breaks this trend line, it will still be in a longer term uptrend, but it will again be softening up quite a bit. I'm going to keep an eye on this benchmark in the coming week and see if it can remain in its current uptrend, if it can rally and stay above the 50-day moving average or this uptrend line again coming in a little over 285. That will be a good thing. That will be bullish for the market. Perhaps it just needs a little more downtime here, and then maybe it can rally higher. Now, if it doesn't, if it comes and falls and closes below the 50-day and continues to fall below this trend line, then I will become certainly more conservative in the market, and perhaps I'll take some profits off the table And if I do enter any new positions, they will be small share size or limited share size, and definitely I'll have some very firm stops on them. This is a great time to exercise caution, and remember, cash is a position. When you're in doubt, get out. The market has to go lower sometimes before it can go higher, and markets don't go up in a straight line forever, and this one's getting a little long in the tooth. So on that note, let's keep an eye on the SPY in the coming week. And now let's look at an exchange-traded fund, an important one that we haven't looked at in quite a while. This is the iShares Russell 2000 ETF. As you all know, the Russell 2000 index follows small caps, companies valued at about $300 million to $2 billion. And the IWM, or the Russell 2000, the underlying index, can act as a leading indicator for the broader market. Right now, I'm sure that's not what you want to hear looking at this chart. I don't either. Now, it did make a new all-time closing high on August 31st, right up here at $173.02. Ever since then, the SPY has been trying to stay above the 20-day moving average and did so until yesterday and today. However, the IWM said the heck with all that, and by the end of September, it was starting to roll over, and in the last couple of weeks, it has moved downward dramatically. Fell right through its 50-day moving average with no problem, no apologies, and has kept moving down. Now it's headed for the 200-day moving average. Now, when I captured this chart, the IWM was trading at $161.31, just atop the 200-day moving average, which is coming in here at 160.94. We can call it 161. Obviously, the RSI, of course, is moving south with the IWM, as is the MACD. Now, we haven't seen a fall like this in a long time from the IWM. Maybe this is the pause that refreshes, and maybe it can find itself and bounce up off this 200-day moving average as it approaches it, and we look toward the coming week. Now, we do know that the IWM, the holdings in it, are sensitive to interest rates because these are small cap companies. They don't have the large accounts and the wherewithal that bigger S&P 500 companies have. So they have to borrow money, and if they're borrowing money at a higher interest rate, of course, that eats into their profits. It does for all of us, for that matter. So part of this move down, I'm sure, that we've seen in the last 2.5, 3 weeks is coming from the IWM, the Russell 2000 components, being pretty darned unhappy that the Fed is raising interest rates because it's going to cost them more money to survive. So please keep an eye on the IWM. Again, it can act as a leading indicator for the broader markets. Now, we do need to know that the IWM, or the Russell 2000, is the drama queen. It usually rises harder and faster and falls harder and faster than the SPY or certainly the Dow and even the NASDAQ. So it really is high drama here with the IWM, but let's keep an eye on it. If it continues to move lower, again, I'm going to stick to my plan of perhaps taking some profits, small share size on new positions, and very, very firm stops. And again, cash is a position. Now, speaking of new positions, let's go on and look at our final chart for the day. This is the iShares U.S. Medical Devices ETF, symbol IHI. We haven't looked at this in a long time. We had a little earlier in the year, and as you can see, the IHI has made a beautiful uptrend ever since its February lows earlier in the year. In fact, well, let's do its top components here. The top components of the IHI are Medtronic, Abbott Labs, Thermo Fisher Scientific, Becton Dickinson, and Danaher. Now, it made a low back here in February, a relative low at about $170, then walked up. Once it got going here, really the beginning of April, it walked up its 50-day moving average very, very nicely, and touched a recent high of $228 on October the 1st. Now, as you can see, since then it's fallen pretty dramatically with, again, rising interest rates. And now it's down, trading as I captured it today at $216.60. And it's sitting right on top of the 50-day moving average, which is coming in at 216.54. Now, I'm not in a hurry here. I'm just going to continue to watch the IHI. I think that healthcare, in a lot of its forms, is certainly going to expand over, let's say, the next decade or so. But of course, there's going to be rocky patches along the way, as there is for everything. I'm going to watch it and see if in the coming week the IHI can actually bounce off the 50-day moving average, if it can come to a level here where institutional players come in and then start to bounce off of the 50-day moving average. If it looks like it has legs, as we say, and decent volume doing that, I may add shares to my portfolio. If, however, in the coming week the market remains really cranky and the IWM makes 3 closes below the 50-day moving average, then I'll probably wander off in a different direction and look for another opportunity. If I do enter the IHI, I will probably, well, I should not say probably, I will, depending on how high it bounces. If it does, I will use a close below the 50-day moving average as my initial protective stop. So keep an eye on the IHI in the coming week. It may be something you want to look at. But again, please don't be in any hurry. And do remember, when you're in doubt in these kinds of markets, go ahead and get out. And now, excuse me, on to the coming week's economic reports. But first, I want to alert you to an exciting opportunity. Please check out my new online training, How to Swing Trade Successfully. In this program, you'll discover the Sleeping Tiger setup and exactly how to use it to make highly profitable swing trades. The Sleeping Tiger setup is the setup that I use for my own trades, and it's also the setup we've been using successfully in Toni's Market Club for the past 10 years. So yes, it's proven. This strategy is easy to learn, and you'll discover how to take the biggest profits out of long upswings safely and successfully. Don't miss out. Check out How to Swing Trade Successfully at the link on your screen below, and get this exciting new online program for 20% off this week only. It's a special discount right now. And now for the coming week's economic reports. On Monday, not much going on, and neither is there any on Tuesday. On Wednesday, we have the Producer Price Index and our usual crude inventories. On Thursday, we have our Consumer Price Index. We have our weekly jobless claims and our weekly natural gas inventories. And on Friday, we have the Michigan Sentiment Report. Again, don't miss out on our limited time offer to grab our new How to Swing Trade Successfully program for 20% off. That won't happen again this year. So please click on the link below for more information. Until next time, keep green on your screen. I'm Toni Turner, and this is The Market Now.